One of the greatest ways for novices to learn how to invest in stocks is to open an online investment account and then invest in stock shares or stock mutual funds. Many brokerage accounts allow you to begin investing for the cost of a single share of stock. Some brokers also provide paper trading, which allows you to practice buying and selling with stock market simulators before investing real money. The simplest approach to invest in stocks is to open an online investment account, often known as a brokerage account, and purchase individual stocks or stock funds. You can also use a robo-advisor or a financial advisor to invest in equities. If you're ready to start investing in stocks on your own, this 6-step procedure can assist. First, decide how hands-on you want to be. Then open an account, decide on an investment strategy, create a budget, think long-term, and manage your portfolio as needed over time. Remember, a smart rule of thumb is to develop a diverse portfolio and then stay involved, even when the market fluctuates. Step 1. Determine how you will invest in the stock market. There are various approaches to stock investment. Choose the option that best describes how you want to invest and how hands-on you want to be in selecting stocks to invest in. A. I'd like to pick my own stocks and mutual funds. Continue watching. This video deconstructs what novice investors need to know, such as how to select the best account for your needs and how to compare stock investments. B. I'd like to have an expert manage the process for me. You might be a good fit for a robo-advisor, a low-cost financial management service. Almost all large brokerage firms and many independent advisors provide these services, which invest your money for you depending on your individual objectives. C. I'd like to start investing in my employer's 401k. This is one of the most typical ways for new investors to get started. In many ways, it teaches novice investors some of the most tried and true investing techniques, such as making tiny regular contributions, focusing on the long term, and having a hands-off attitude. Most 401k plans provide access to a restricted number of stock mutual funds but not to individual equities. Step 2. Select an investment account. You're ready to look for an investment account once you've decided on a preference. This is usually a brokerage account for the hands-on kind. Opening an account with a robo-advisor is a good choice for those who need some assistance. Both techniques are described in detail in this video. A key factor to remember is that both brokers and robo-advisors allow you to start an account with very little money. The do-it-yourself option: create a brokerage account. An online brokerage account is most likely the quickest and least expensive way to purchase stocks, funds, and other investments. You can start an individual retirement account, commonly known as an IRA, with a broker, or you can open a taxable brokerage account if you're already saving for retirement in an employment 401k or other plan. Opening a robo-advisor account is a passive alternative. A robo-advisor provides the benefits of stock investing without requiring its owner to undertake the labor involved in selecting individual assets. Complete investment management is provided by robo-advisor services. During the onboarding process, these businesses will question you about your investment goals and then create a portfolio to help you reach those goals. This may appear to be pricey, however, the management costs here are often a fraction of what a human investment manager would charge. The majority of robo-advisors charge around 0.25% of your account balance. And, yes, you can open an IRA using a robo-advisor. Step 3. Understand the distinction between investing in stocks and investing in funds. Considering doing it yourself? Don't be concerned. Stock investing does not have to be difficult. For most people, stock market investing entails choosing between two sorts of investments: mutual funds or exchange-traded funds that invest in stocks. Mutual funds allow you to buy little amounts of many different equities all at once. Index funds and ETFs are types of mutual funds that track an index. For example, a S&P 500 fund duplicates that index by purchasing stock in the firms that make up the index. When you invest in a fund, you own a little portion of each of those companies. You can combine various funds to create a diversified portfolio. It's worth noting that stock mutual funds are also known as equity mutual funds. Individual securities. If you're looking for a certain firm, you can buy a single share or a few shares to get your feet wet in the stock market. It is feasible to construct a diversified portfolio out of numerous different equities, but it requires significant effort and research. If you pursue this way, keep in mind that individual stocks will experience ups and downs. If you research a firm and decide to invest in it, remember why you chose that company in the first place if you are nervous on a bad day. The advantage of stock mutual funds is that they are naturally diversified, which reduces your risk. A portfolio comprised primarily of mutual funds is the obvious choice for the great majority of investors, particularly those investing their retirement resources. However, mutual funds are unlikely to climb as quickly as certain individual equities. The advantage of individual stocks is that a clever choice can pay off handsomely, but the chances of any specific stock making you rich are extremely tiny. Step 4. Establish a budget for your stock market investment. During this stage of the process, new investors frequently have two questions. How much capital do I need to begin investing in stocks? The amount of money required to purchase a single stock is determined by the price of the shares. Share values might range anywhere from a few dollars to many $1,000s. If you want to invest in mutual funds but have a limited budget, an exchange-traded fund, ETF, may be your best option. Mutual funds frequently have minimums of $1,000 or more, while ETFs trade like stocks, so you buy them for a share price, in some circumstances, less than $100. How much should I put into stocks? If you're going to invest through funds, have we mentioned that this is the preferred method of most financial advisors? You can dedicate a significant portion of your portfolio to stock funds, particularly if you have a long time horizon. A 30-year-old planning for retirement might put 80% of their money in stock funds and the remainder in bond funds. Individual stocks are a different story. As a general rule, confine these to a modest amount of your investment portfolio. Step 5. Concentrate on long-term investing. Stock market investing has shown to be one of the most effective strategies to accumulate long-term wealth. The average stock market return over multiple decades has been around 10% per year. However, keep in mind that this is only an average for the entire market. Some years will be up, some will be down, and individual stocks will differ in their returns. The stock market is an excellent investment for long-term investors regardless of what happens day to day or year to year. It's the long-term average that they seek. The most difficult thing to do after you start investing in stocks or mutual funds is to not look at them. Unless you're aiming to beat the odds and excel at day trading, you should avoid the practice of monitoring your stocks multiple times a day, every day. Step 6. Take charge of your stock portfolio. While obsessing over daily swings isn't good for your portfolios or your own health, there will be moments when you need to check up on your stocks or other investments. If you use the techniques outlined above to acquire mutual funds and individual stocks over time, you should review your portfolio at least once a year to ensure it is still in accordance with your investment objectives. Consider the following. If you're nearing retirement, you may want to shift some of your stock investments to more conservative, fixed income investments. If your portfolio is overly concentrated in one sector or industry, consider purchasing stocks or funds from a different sector to increase diversification. Finally, consider geographical diversification. Vanguard recommends that international stocks account for up to 40% of your portfolio. You can gain this exposure by investing in international stock mutual funds. Picking stocks can be a daunting task, especially for novices. After all, thousands of equities are traded on the major U.S. exchanges. The investing process is rife with complex tactics and approaches, yet some of the most successful investors have done little more than stick to the market fundamentals. That often means relying on funds for the majority of your portfolio. Warren Buffett famously stated that a low-cost S&P 500 ETF is the best investment most Americans can make, and selecting individual stocks only if you believe in the company's long-term development potential. The S&P 500 is an index that includes approximately 500 of the largest publicly traded firms in the United States. Over the previous 50 years, its average annual return has been almost the same as the market's at 10%. The bottom line on stock investing for novices: learning how to invest in stocks can be intimidating, but it's really simply a matter of determining which investment technique you want to employ, what kind of account is best for you, and how much money you should put into stocks. What type of investor are you? Leave a comment below. Take care and remember that your money matters.